Welcome to the SafeSimpleSound podcast, where our approach to financial planning creates both and solutions for the contradictions families face every day. We believe you don't have to choose between growth and safety or between sophistication and simplicity. You can have a financial life that is safe, simple, and sound. Today, we are stepping into a topic that often feels mysterious, perhaps even a little exclusive. We are exploring the world of alternative investments. This episode draws directly from our recent blog post, Beyond Stocks and Bonds, because we've noticed a pattern. Once families have mastered their core foundation, once the retirement accounts are funded and the emergency savings are full, they naturally ask, what else is out there? Whether you are an experienced investor, wondering about that private real estate deal your neighbor mentioned, or you're just beginning to build your wealth and want to understand the full landscape, this episode will give you a framework for understanding how these complex assets fit into a sound financial home. To get us started, let's use an analogy that we love here at the practice. It aligns perfectly with our simple mandate. Think of your investment portfolio like a professional chef's kitchen. In this kitchen, stocks and bonds are your salt and pepper. They are the essential, foundational ingredients for nearly every successful recipe. You can cook a magnificent meal using just these basics if the technique is right. They provide the core nutrition and flavor of the financial plan. Alternative investments, they are the exotic spice rack. We're talking about saffron, cardamom, or perhaps a rare truffle oil. Used sparingly and with expert knowledge, these ingredients can add incredible depth and unique flavor to the dish. They can turn a great meal into a world-class experience. But, and this is crucial, they aren't for every dish. And if you use them incorrectly, or if you use too much, they can completely overpower the meal, ruining what was otherwise a perfectly good dinner. Through our Safe Simple Sound methodology, we want to hand you the keys to this spice rack. Not so you can dump exotic spices into every pot, but so you can understand what they are, why they exist, and how a financial plan determines when to use them. In this episode, we are going to define what alternative actually means without the jargon. We will explore the landscape of real estate, private equity, and commodities. And most importantly, we will walk through a hypothetical scenario to demonstrate exactly how our team analyzes these opportunities to ensure they remain safe, simple, and sound. Let's begin by clearing the fog around the terminology. So, what does alternative actually mean? In the financial media, this term is often whispered with a sense of intrigue. You might hear murmurs about private equity funds, hedge funds, or venture capital. It can feel intimidating, which violates our principle of simplicity. So let's make it simple. From a professional standpoint, an alternative investment is simply any asset that isn't one of the three traditional types: stocks, bonds, or cash. That's it. If it's not a stock you buy on the New York Stock Exchange, a bond issued by a government or corporation, or cash in the bank, it is likely an alternative. Now, why do we categorize them separately? It's not just to be difficult, it's because they behave differently. Drawing from our CFC background at SafeSimpleSound, we look for assets that provide low correlation. That's a technical term, so let's translate it. Publicly traded stocks and bonds tend to have a relationship with the general mood of the economy. When the S&P 500 drops, many stocks drop together. Alternatives often operate in a different universe. Their value doesn't always move in the same direction as the stock market. When the stock market zigs, a well-chosen alternative might zag, or it might just stay steady. This aligns with our principle of soundness. We are looking for structural integrity. By adding something that doesn't move in lockstep with the stock market, we are potentially stabilizing the foundation of the house. Let's look at the three major categories we see most often in our practice. First, there is real estate. Now, we aren't just talking about owning your own home. That is a use asset, something you live in. We are talking about investing in commercial properties, apartment complexes, or undeveloped land. For most individual investors, buying an entire apartment complex is neither safe nor simple. It requires massive capital and management headaches. So, in the alternative investment world, we often look at vehicles like private real estate funds. This allows you to own a slice of a massive property portfolio. You get the benefits of real estate, potential rental income, and property appreciation without ever having to fix a leaky toilet or evict a tenant. Second, we have private equity. If buying stocks is like buying a ticket to ride a train that is already moving, private equity is helping to build the train. This involves investing directly in private companies that are not listed on a public stock exchange. This could range from providing seed money to a promising startup, often called venture capital, to helping a management team buy out an established company to improve it. The goal here is growth. The strategy is to help these companies mature so they can eventually be sold or taken public. When that happens, the early investors can generate a significant return. However, this is a long game. It is not for money you need next week. Third, we have commodities. This is the stuff of the economy, raw materials. We are talking about gold, silver, crude oil, natural gas, corn, and coffee. Now, from a SafeSimpleSound perspective, we rarely recommend clients store barrels of crude oil in their garage. That is certainly not simple. Instead, investors gain exposure to these prices through specialized funds. Why would we do this? Commodities, especially gold, are often seen as a safe haven asset. When investors are nervous about the currency or the stock market, they often flock to tangible assets. It brings a different type of ballast to the ship. So why do we use these? Why would a sophisticated investor venture beyond the comfort of stocks and bonds? Why mess with the spice rack at all? Through our SafeSimpleSound framework, we identify two primary motivations: advanced diversification and the potential for higher returns. Advanced diversification is the safe component. Because these assets don't move perfectly with the stock market, they can act as a shock absorber. If the stock market is having a volatile year, a private real estate fund might be steadily collecting rent, unaffected by the daily news cycle. This creates a smoother ride for the family's net worth. The potential for higher returns addresses the sound component of growing wealth to outpace inflation. Investing in a young company before it becomes a household name can offer growth that is hard to find in established public companies. However, and this is a massive however, we must apply the safe filter again. There is no free lunch in investing. The potential for higher rewards is always, without exception, balanced by unique risks. The biggest risk? Illiquidity. This is the single biggest difference between stocks and alternatives. You can sell a stock in seconds on your phone. You cannot sell a private equity share quickly. When you enter these funds, your capital is often locked up for 5, 7, or even 10 years. We call this the liquidity premium. You get paid potentially higher returns because you are willing to lock your money away. But if you need that money for an emergency, you are stuck. There is also complexity. These are not simple index funds. They involve dense legal documents and complex fee structures. And finally, access. Many of these are only available to accredited investors, a specific designation based on income or net worth. So how do we know if this is right for a family? How do we take these abstract definitions and apply them to real life? To help you understand this, let's move to our deep dive. We're going to look at a hypothetical scenario that illustrates exactly how our team applies the S3 framework to these complex decisions. Please keep in mind that this story is created for educational purposes to demonstrate the patterns of thinking we apply in our practice. It does not represent a specific client, but rather a composite of situations we encounter. Let's picture a fictional couple. Let's call them Marcus and Elena. Marcus is 52, a surgeon, and Elena is 50, a successful architect. They have done everything right by traditional standards. They have maxed out their 401k for years. They have a healthy emergency fund in cash. They have a brokerage account invested in a diversified mix of stocks and bonds. Their salt and pepper are perfectly balanced. One evening, at a dinner party, a friend tells Marcus about a private real estate opportunity. It's a fund buying commercial medical buildings. The friend claims it has been paying out 12% annually and is immune to the stock market. Marcus and Elena come to our practice with excitement. They feel their current portfolio, while growing, feels a bit boring compared to this 12% opportunity. They want to take $200,000 of their savings and put it into this fund. Now, without a framework, one might just say 12% sounds great, let's do it. Or conversely, that sounds like a scam, don't do it. But at Safe Simple Sound, we step back. We apply the framework. First, we look at the sound principle regarding accreditation and suitability. Before we even look at the deal, we look at Marcus and Elena. To invest in many private placements, you must be an accredited investor. Generally, this means having an income of over $200,000 individually or $300,000 combined for the last 2 years, or a net worth of over $1 million, excluding your primary home. In this hypothetical, Marcus and Elena meet this criteria. They have the capacity, but just because you can do something doesn't mean you should. Next, we apply the SAFE principle regarding liquidity. We ask Marcus and Elena. Elena mentions that in 3 years, their twin daughters will be starting college, and they were planning to use some of this capital to pay for tuition. This is the critical SAFE moment. We review the documents of the hypothetical real estate fund. It turns out this fund has a lockup period of 7 years. If they put the money in now, they cannot get it out when the tuition bills arrive in 3 years. If they had proceeded without this check, they would have created a liquidity crisis. They would have an asset, on paper, that is worth money, but they would be cash poor when they needed it most. Then, we apply the simple principle regarding due diligence. We look at the fund itself. The friend said it pays 12%. But upon reviewing the prospectus, the detailed legal document, we see that the 12% is a target, not a guarantee. Furthermore, the fees are high. There is a 2% management fee and a performance fee. We explained to Marcus and Elena that while the real estate underlying the investment is good, the complexity and the fees create a hurdle. To net that 12%, the properties actually have to perform much better than the market average. So what is the solution? In this scenario, our team might guide Marcus and Elena toward a both-and solution. They want diversification, the spice, but they need liquidity for college, the safety. Instead of the locked-up private fund, we might explore a public real estate investment trust REIT or a liquid alternative fund that offers exposure to real estate, but allows them to sell the shares if they need the cash for tuition. Or perhaps we take a smaller portion, say $50,000, that they truly won't need for 10 years and allocate that to a private equity strategy for long-term growth while keeping the college money in high-quality bonds. While this story is fictional, it demonstrates how our framework protects families. Notice what we didn't do. We didn't say real estate is bad. Real estate is a wonderful asset class. We didn't say private funds are bad. For the right family with a 20-year timeline, they can be incredible wealth generators. What we identified was a misalignment between the characteristics of the investment illiquidity and the needs of the family college tuition in 3 years. This is the pattern we see constantly. Families are often sold a product based on its potential return, ignoring its structure. Through our Safe Simple Sound practice, we've observed that the most dangerous investments aren't necessarily scams. They are often legitimate investments used in the wrong way or at the wrong time. Whether you are facing this exact situation with a private deal, or perhaps considering buying a rental property, or investing in a friend's business, the questions remain the same. One, is it safe? Can I afford to lose this money or lock it up for a decade? 2, is it simple? Do I truly understand how it makes money and what the fees are? 3, is it sound? Does it act as a counterbalance to my stocks, or is it just adding more risk to the pile? This hypothetical example illustrates that alternative investments are not a magic wand. They are a tool, and like a power saw, they can build a house faster, or they can cause injury if handled without respect and training. As we begin to wrap up our exploration of alternative investments, let's return to our chef's kitchen. We've established that stocks and bonds are your salt and pepper. They are the nutritious foundation. We've learned that alternatives, real estate, private equity, commodities, are the exotic spices. They offer advanced diversification and the potential for higher returns. They allow for a sophisticated flavor profile that can weather different economic seasons. But we've also highlighted the risks. The heat of these spices comes in the form of illiquidity, complexity, and higher costs. The key insight from today's episode and from our blog post is that you do not need alternatives to have a successful financial plan. A salt and pepper meal can be delicious and sustaining. However, for the family that has built a strong foundation, has excess liquidity, and is looking for that next level of structural integrity, alternatives can be a powerful addition. This aligns with the principle of stewardship. Being a good steward of wealth means knowing what you own and why you own it. It means never letting the allure of a hot tip override the safety of your plan. If you are listening to this and realizing that your portfolio might need a review, perhaps you have too many illiquid assets, or perhaps you are entirely exposed to the stock market and need some diversification, there is a path forward. Navigating this complex landscape is where our team's CFFC background serves as your guide and gatekeeper. In our practice, we help families determine if they meet the criteria of an accredited investor, analyze whether their risk tolerance and time horizon can handle the lockup periods, perform the rigorous due diligence needed to vet these complex opportunities, and most importantly, integrate these spices into the broader meal in a thoughtful, strategic way. This episode draws from our recent blog post titled Beyond Stocks and Bonds, a CFC's Introduction to Alternative Investments, which you can find at SafeSimpleSound.com. The blog contains additional details and a visual breakdown of these asset classes that serves as a great reference guide. Through our S3 approach development, we've created a process to help you evaluate these opportunities objectively, stripping away the emotion and the sales pitch. If today's S3 insights resonate with your family's situation, if you are that accredited investor wondering if it's time to expand your horizons, we invite you to explore what financial planning could look like through our SafeSimpleSound practice. But either way, whether you reach out to us or not, you are now equipped with a capability. You now know that alternatives simply means different than stocks and bonds. You know to ask about liquidity. You know to look for low correlation. You have the knowledge to look at that spice rack with confidence, not confusion. That is the goal of SafeSimpleSound, to replace anxiety with clarity. Thank you for listening. We look forward to helping you build a financial life that is safe, simple, and sound.